Welcome to Next Gen Finance, and today we are talking about the one question almost every household in the UK is asking right now, and that is UK inflation today. Is it truly getting better, or is it quietly getting worse underneath the headlines? This is not just an economist topic. This is the cost of supermarket shopping, your rent or mortgage, your car insurance, your gas and electricity bills, even your emergency savings. Everything connects right back to inflation. So today we are breaking down what it is.
It's truly happening right now. Not what politicians want you to believe, not the headlines trying to scare you, not the influencers trying to hype it up, but the real picture on the ground. And by the end of this video, you will genuinely know if your wallet is getting a little relief or if we are just temporarily breathing before the next inflation wave hits.
So here is the first truth. Right now, inflation looks like it is slowing on the surface. That is what the new data shows. The headline number looks softer. But when you zoom in category by category, it becomes obvious that the easing is not equal. Some categories are stabilizing, others are still rising quietly and aggressively. Electricity, insurance, rents, car finance, food services, and used cars are still pushing up on the average household cost. And this is the dangerous thing. A lot of people see the headline inflation number and assume the worst is over. But the real-life basket of the average British household has not gone back to cheap. It has only stopped getting more expensive at the same speed. Yes, it is better than 2022 and 2023 when inflation was brutal and painful and everyone felt it. But better does not mean good. It simply means slower pain. For example, insurance has become one of the most expensive parts of the household budget. We keep seeing people comment online saying, groceries might have stopped rising, but why is my renewal more expensive than last year? And that is exactly the point. UK inflation today is not moving equally. Where prices are falling and where it is sticky are different stories. And here is the second truth. Today in the UK, inflation is not just being driven by commodities. It is now being driven by services. Mortgage rates, rent, private rental sector landlords facing higher financing costs, passing them to tenants. Also, utilities were predicted to soften, but wholesale and retail pricing are not perfectly matching, and consumers are paying the premium on the lag. So inflation today might look softer in the official release, but the cash going out of households weekly is still massive. Impressive. People still feel squeezed, and the reason is categories that matter the most day to day have not deflated. Now the million-pound question, will the Bank of England cut rates faster because inflation is cooling? Or will they hold longer because they are scared that cutting too early creates another wave? The current tone from the bank is cautious. They are not signaling fast cuts. And the more stubborn the services inflation stays, the more likely that the peak pain for households will remain for longer. And here is something many people do not talk about. Even when inflation slows down, it does not mean we go back to old prices. When inflation drops from 10% to 3%, that does not mean prices go 7% cheaper. It means prices are rising at 3% instead of 10%. The base levels stay high. That is why people feel confused, because the maths is deceptive. If something was £100 and then went to 120, and then inflation goes from 10% to 3%, the price does not return. And to 100. It stays near 120 and then goes a bit higher. So even if inflation today looks normal, the cost of living stays expensive. This is why many households say it does not feel like inflation has fallen, because the price level has not fallen. The growth speed has slowed. That difference is huge. Now, will things get better or worse? The answer is it depends on three drivers: central bank pace of interest rate cuts, wage growth momentum,
and global energy pricing. If salary growth stays above inflation, that is good for households. But if inflation picks up while wages stagnate, the pain increases again. The data right now shows wages are still growing, but not at the same explosive speed as last year. And here is another reality. If rates stay higher for longer, mortgage resets will be a bigger shock next year. The wave of remortgaging is not even halfway through. And tenants feel it too, because landlords price their rent based on their own monthly payments. For people watching this video, the most powerful thing is not what the number is today, but what you do with this time. Because whenever inflation cools down even a little, that is actually a chance for households to stabilize their debt repayment strategy, optimize bills and subscriptions, move savings into better yield accounts, challenge renewal quotes, and avoid lifestyle creep, which means do not increase spending just because inflation slowed or because you saw a bit of relief. This is not a party. This is a silent micro-recovery period, and smart people maximize these windows. So, is inflation today better or worse? The honest answer is the headline number is better, but the real lived wallet impact is still painful. And the danger now is false confidence. Because when people believe the pain is gone, they stop financially defending their future. But the next shock, whether it is oil, whether it is shipping, whether it is rate policy, can hit without warning. So do not take this as a relief zone. Take this as a positioning zone. This is the moment to protect and prepare, because the winners in every economic cycle are never the people who react after it happens. They are the ones who position while the change is still in progress. Before we close, think about this. If inflation never goes back down fully, but wages do not rise in the same proportion, then every single year, households get financially thinner. That is why you need to measure your life not by salary number, but by purchasing power. And that is why Next-Gen Finance exists, to translate complicated economic language into real human money sense, so you understand what is actually happening behind the headlines, and you do not make decisions based on fear or hype, but base. Dawn on data clarity and strategy. So if you got value today, like this video, share it with someone who needs clarity, and subscribe to Next-Gen Finance, because we are building a community that wins by thinking earlier than the crowd. And tell me in comments, do you personally feel inflation is calming down, or do you still feel your weekly expenses are heavier than last year? Your lived experience matters more than any headline. This was Next-Gen Finance, and I will see you in the next update. Stay smart, stay prepared, and stay ahead.